Good morning, ladies and gentlemen. Whenever things start becoming nonsensical, it always pays to have a look at history. This is a monthly chart of the S&P, and as you can see, it is now spiking the Bollinger Band, which comes in around 23, 27. It is very rare for the market to be able to sustain a move of 2 standard deviations away from the mean, which is what the Bollinger Band is. The only time in history where it successfully done it was 1995, which is this period here. But the situation in 1995 was completely different from the economic situation now. That was a period of acceleration in growth. That was a period of rising interest rates and of the Fed trying to calm down exuberant spirits by hiking rates. The global economy was firing on all cylinders and things were much, much brighter. The other periods when it did so were always retraced. We're talking about 97, 98, 99, and finally 2006 and 2007. What does that tell us? It tells us that we are in a period of great uncertainty and that this rise is actually not the product of buying, but we think of an absence of selling. Will the market inflate further is the real question. And the answer is probably yes. Markets always inflate far more than anybody can withstand staying short. What is our best guess as where we are in the greater scheme of things? Well, we think that we are answering this rise from 2000 and early 2009 up to late 2010, where this would be the first wave up and this would be the third wave up, and now we are answering it again in the fifth wave up before the end of the bull market. Can this go further? Yes. We have objectives of the end of the third wave of the fifth wave around 2367, and then finally the end of the fifth wave at around 2500, which would make sense. We are at the moment spiking these Bollinger Bands. We think we go a couple of percentage points maximum further, come back, retest this line and relaunch again to around 2500 before the end of the bull market, which will provide us complete symmetry with wave one, which started in 2009 by the Fed's action. If we look at a chart of the Nasdaq 100, we seem to be in a period very much reminiscent of 1999, these spikes of the Bollinger Bands which last several months and go to much higher highs. Whichever index we look, we think it is very much reminiscent of 1999, a period of great excess which was finally corrected in an almighty crash. But it's a period which lasted many, many months and went far further than anybody thought was possible. A chart of fundamental expectations of earnings also would negate that we could possibly be in a 1995 period. The thrust for higher prices that we had in 1995 came from P's which were around the 12 to 13 area, and that took the market up to 15 times expected earnings. We are now thrusting around the 18 times earnings, and this is very much reminiscent of 1998 and 1999, when earnings went from just below 20 to actually spiking the 25 times level. So as you can see, we have quite a bit of room on the upside if we are emulating something that happened in 1998 and 1999. We could easily go to 2500 without any problems. On a weekly chart, you can see how stretched we are becoming, how nonsensical this is all becoming. We are way over 17 times earnings, and what we would rather expect is happening is that people are holding back from selling by the expectations or the uncertainty as to Trump's tax package. It could very well be a period in which people are saying prices are going higher. I'm not going to sell the stocks I have until I have clarity as to what the picture is going to look like in the economy after the Trump package has been introduced and we have more clarity. That means that any small marginal buying is actually very bullish for the market, because it takes out stock that is just not in supply. Companies continue buying back doing buybacks, buying back their stock. There's very little stock available, so we think this is actually a squeeze in terms of stuff that isn't available for sale, as opposed to people enthusiastically buying at these levels. It could very well be a situation in which we will see a lot of selling after a tax package which even mildly disappoints market expectations. When we continue our fundamental analysis looking at the individual sectors, there isn't a single sector which is not vastly overbought. Consumer discretionary is now as high as it has ever been in its history. Consumer staples are very close to the highs they had in 2016. Energy is a complete mess, but I suppose it could go a little bit higher. Financials have spiked through an area which they have never been able to sustain, which is the 14 times earnings, but they have huge expectations from the new regulatory regime that Trump says he is going to enforce. Therefore, we could possibly see more from financials. And healthcare is the sector which is probably the cheapest one fundamentally, and the one that people are seeking as a refuge. When things become completely nonsensical, people go instinctively to defensive sectors which are not overbought and make them overbought as well. So healthcare probably has more room to rise, and industrials are now at levels which were probably last seen in 1998 and 1999. So all our analysis confirms the analogy to 1998 and 1999, where several months of thrusts higher eventually resulted in a ridiculous overvaluation of the market and a very abrupt end to it, with much lower prices which followed over the course of the next 3 or 4 years. We think we are answering 1998, 1999 at the moment, and that we will have several thrusts higher over the course of the next several months before the market exhausts itself and starts a rapid fall. So what are our longer term expectations? Very tough to say, but we think we are very close to a top of this third wave within the fifth wave. The top should be somewhere around the 2370 area, to be answered by a fall back to 2300, to be answered by a new high around 2500 before the market collapses to around these areas where it came from, which is around the 2000 area. When will the top be? Well, the top will be much later than people think, and the thrusts will be a lot higher than people can expect. Therefore, we think that for the next at least 6 months, the path of least resistance is higher, and all sharp dips need to be bought. When the market is working so well on Elliott wave, it is silly to fight it, and it is always profitable to buy the dip when people get very bearish. We have in no way seen the top. Every market that we look at, whether it be emerging markets or European markets, is telling us more or less the same story. This is a chart of emerging markets. It is very probable that we will test this line here, which is around 41, within the next couple of months before we come back, and then finally go much higher and probably test all the way up to 55 by the end of the year. So since all related markets to the US are telling us that prices are heading much higher, it would be nonsensical of us to expect the S&P to top over the course of the next month or so. We think there will be many more thrusts in the S&P, which will take the market, well, nearly 10% higher than the current level. Therefore, all dips are to be bought, in our opinion. When things get nonsensical, you have to go with them rather than fight them, because that level of inflation lasts far longer than anybody can predict. The one indicator which makes us think that we are right and that we will see a top somewhere around 2370 for a violent move back down to at least 2300 is the new relationship which is forming between volatility and price action. As the market rises, we always before had fall in volatility. Volatility now has started rising on higher prices, which basically means that people are beginning to be very uncomfortable with selling volatility at these levels, even when prices are rising. That makes complete sense to us, because if we're going to have very tough markets to trade, which go up 2% before they come down 4%, before they go up 8%, volatility is a buy at these levels. We think that every time the market now spikes to our target levels, the best thing to do is to buy volatility, and every time the market falls to our target levels on Elliott wave, the best thing to do is again to buy volatility through calls. So from now on, we think that trading the outrights is going to be far less profitable than trading option strategies. This is a chart of the stocks, the European index, a monthly chart. and you can see how the Bollinger Bands are way higher, around the 3,540 level, and how this 3325 level has been holding it for the past couple of months. We would now expect a very sharp move up to 3540 within the next couple of months, and so we think that any dip down to 3300 is going to be 3200 is going to be a very good level to pick up stocks and see it go up by approximately 10%. It is a market which is being held back by political uncertainty, and any resolution of that political uncertainty over the course of the next couple of months after French elections is going to favor the stocks market, and it is probably time to start accumulating long positions for the long term in stocks. We think that by the middle of the year they will be trading above 3500. Compare and contrast this to the chart of the DAX. The DAX is also up against its monthly Bollinger Bands, which would imply that the stocks has much more room to rise relative to DAX, which would actually mean that the tensions within the European market will be resolved positively for peripheral Europe compared to Germany. This is something that makes sense, and this is something which actually now makes us bearish of the Bund BTP spread. So we think that a period of risk on will follow in Europe by the end of April, let's say, and which will see the prices of peripheral Europe go up much more than the prices of Germany. However much clarity we're beginning to have about the future movements of the stock markets, we are continuing to be in a very puzzling trading range in the bonds. This is the five-year yield. On a daily basis, we had the break that we were anticipating last week for higher yields and lower prices. That break lasted all of 2 days, and by Friday we were again within the triangle. This is price action which indicates extreme uncertainty. People are afraid of taking prices much lower and yields much higher. We know the market is very short duration, and therefore we are beginning to give up on trading this market. There's absolutely no clarity, no break is sustained. When that happens, it is the sign of a trading range which needs to resolve itself before we can with confidence put on any new positions. There seem to be so many cross currents in the interest rates. As you can see, the 5-year note broke the triangle, came back within it, while the 10-year note never broke the triangle. It got right to it and gave it up. What we shall now wait is for both 5-year and 10-year to confirm a move in either direction before we take any positions in these markets again. In Europe, the Bund and the Bobl, and this is a chart of the Bobl, are being held back by fear. Fear of what will happen in the French elections, fear what will happen in the Dutch elections, and so on, which longer term is exactly what we would like to see, because we want to be sellers of this market, And at the moment, we're getting higher prices out of fear. People are just parking their money in negative yielding instruments like the 2-year note in Germany, the 5-year note in Germany, and they're not investing in Italy or France out of fear. Well, you can imagine what that is going to look like when that fear actually subsides. There is going to be an almighty crash in 5-year notes in Germany, and we want the prices actually now to go up as high as possible before we can initiate positions just before the elections, playing the odds that things will turn out just well, thank you very much, and we can actually sell bobble and buy stocks and enjoy the ride. We think that is going to be the next big trend, sometimes in March or April before the presidential elections in France, and the big trade was going to be sell bobble, buy stocks and enjoy the ride as everything turns out to be well enough in Europe. Finally, a brief look at our commodity indices and what they're telling us. They had a non-eventful week. They all closed very much where they opened, but they are setting up for higher and higher prices. Few weeks of moving in a sideways range will widen the Bollinger Bands and make these markets much more likely to break to the upside than to the downside. We will wait and be ready to position ourselves when those breaks occur, because they will actually have profound influence on the next move in the bond markets and also naturally in equities. Our biases for next week: again, in the 5 and 10-year note, we want to see a confirmed break by both this time, having been chastised by the 5-year note. We want a break in both, so the whole of the yield curve is moving rather than just the 5-year note. Bund and bobble we are going to leave alone for the time being, because we think the political uncertainty is in a period of ascendancy as opposed to resolution. People are getting more and more afraid. Let them. So we want to maintain our bias, but we don't want to trade it as yet. We are still convinced that ES has very little fundamental upside. We think 2365 area is going to be an area to short via options, but from now on, because of the behavior of the volatility indices, we want to play everything nearly exclusively with options. We still prefer the Russell to the ES or the NQ, but 1346 is still our absolute line in the sand. Any close below there and we would stop out any position that we had on the long side. We still think that 1430 to 1450 is the upside target for the Russell in the next few weeks. We still prefer European equities. 3325 is still the level that they cannot break, and any move back down to 3200 or hopefully to 3100 we should aggressively buy as a signal that we will have a very much higher move in prices against DAX and against ES as the European political tensions resolve themselves positively for the market. And therefore the next big trade we think is going to be short bobble, an instrument which is at minus 45 basis points per year in yield, and long stocks, something which is trading at 13 times earnings. We think that's going to be the big trade for the remainder of the year, and we're looking for a very advantageous place to put it on. Thank you very much indeed. Have a nice President's Day and see you on Tuesday.